Everyone is about to tell you that Bitcoin has just turned the corner. Why? Well, because we had the first green day after weeks of outflows in the ETFs. We had the first positive day of inflows. And the timelines are going to be flooded with "we're back" quotes and all of that other bullshit. Well, I personally don't buy it. I don't think that this is going to be saving us because on July 2nd, if you didn't know, we got a positive inflow after weeks of pain. And this might feel like a big relief. Well, it's not. It's just a temporary push upwards. I have covered my theses on why we're going to be going down in my previous videos, which you can check out. But if you didn't watch them yet, well, I'll be explaining it all over here again. So let me show you why it hasn't changed, and let me explain you why we're still probably going to be going down. So first things first, let's deal with the flows first, because this is what everyone is going to be hanging their hopes on. June was one of the worst months in Bitcoin ETF history. Just outflows week after week, millions upon millions of dollars. Then July 2nd happened, plus $223 million. First green day in a long time. Worth noting, I'm not going to be pretending like it did not happen. But here's the actual problem. One day right here, this one green day doesn't undo the billions in outflows we had. Institutions were the ones selling on the way down. They were marginal sellers. One day of buying doesn't make them the marginal buyer again. Until we see sustained inflows, and I mean plural, over multiple weeks, not a single green candle is going to be convincing me that we have changed, right? So until I see sustained inflows, I'm not calling this a bottom. Right now, this for me at least smells like it's shorts covering, right? And perhaps some early buyers stepping up, not a structural shift in institutional demand. Because one good day doesn't erase a bad month. And this is not my opinion. This is just pure math. So if the outflows aren't the real story, what is? Well, there's three things, right? And none of them have changed in my theses. First of all is number one, the Fed. The Fed is still hawkish. Kevin Warsh's first FOMC meeting pulled forward guidance off the table entirely. And as you can see right here, this article says that Warsh says inflation outlook has improved, but he won't be saying if Fed should hike rates. So forward guidance basically means that we have zero knowledge how the Fed will act. Even if inflation prints cool down from here on out, because the inflation is coming in very, very hot, we have zero clarity on how the Fed will actually respond. No guidance means no confidence, and markets hate that more than bad news. That is entirely one of the reasons why we had so many outflows in the first place. Now, here is the interesting thing. The second thing that we're seeing is long-term holders are selling. Right here, you can see that the long-term supply is actually starting to rise, right? But we're seeing something very common in the late stage corrections. Long-term holder supply is rising, but long-term holder stopper is dropping sharply. What this actually shows us is that weaker long-term holders are capitulating and selling at a loss, while stronger hands, such as whales and accumulators, are absorbing that supply. This is classic behavior we see near the later stages of a bear move or correction. The fact that software is at such low levels right now tells us that even some long-term holders are giving up on their positions entirely, which usually adds fuel to the downside before we actually bottom. So while some accumulation is happening, this is happening while capitulation is still taking place. That's why I'm still treating this bounce as a potential trap until we see clearer signs that the selling pressure has actually been exhausted. Now, the last and the third thing is risk appetite. We see that S&P is literally rising. It's putting up gains on the table every single week. So this basically tells us that risk appetite still exists. It's just not coming to crypto, which is very, very bearish in my opinion, because money is pouring into AI and tech, and the S&P is printing new highs, but Bitcoin is literally doing nothing or dropping. So risk on is happening, but Bitcoin is just not at that place right now. So for me, until flows turn consistently positive and the Fed gives the market something to hold on to, this bounce, in my opinion, is very, very, very fragile. That's the whole thesis. Now, to be fair, because I'm not here just to doom post at you, right, and call that Bitcoin is going to zero, there is one genuinely constructive development. The Iran and US situation is de-escalating, which is very good. Stocks are progressing and oil has dropped hard. Brent's sitting in the low 70s now, way off the highs from the earlier in the conflict. And that actually matters because lower oil takes one of the biggest upside risks to inflation off the table. It gives the Fed more room to breathe later this year as well. And this is the part people skip past because it's inconvenient. It hasn't been enough to flip the entire picture. The market's still staring at a hawkish Fed and a Bitcoin ETF complex that hasn't proven it wants to buy it. Geopolitical relief stabilized things, it didn't start a new trend. So basically, this geopolitical relief that we're seeing stabilized things a bit, but it definitely didn't start a new trend for Bitcoin. Good news that isn't enough is just still not enough. But of course, I'm not stupid, I'm not retarded, I'm not married to my thesis, right? I'm not married to this call. A few things that would flip me over. Well, first thing is, again, reverse engineering back. It's sustained positive ETF flows. Not a single day, but real weeks of green, not again a few days of positive numbers. And I'm also watching June CPI on July 14th closely because if that print comes in cooler and the Fed's tone softens with it, that's a legitimate catalyst for us to go up. Until then, I'm treating this as a trap until proven otherwise. So let's land the plane right here. First positive ETF day in weeks, I ran de-escalating, both real, both constructive. But the foundation underneath the bounce is still very, very soft. Flows aren't sustainably positive, the Fed is still hawkish, and long-term holders are still bleeding out. One good week will not be fixing this. I still think this bounce from 58,000 to 62,000 is more like a trap than a turnaround. I do strongly believe that we will be reversing in this move right here soon until, of course, the listed things in my thesis change. But until then, I still strongly believe that we will be breaking $60,000 and going below 58,000 very, very shortly.